Good morning, everybody. As I said, my name is Mark Spencer, and I lead our Financial Services Accounting Advisory practice at BDO. As I said, thank you for joining us. And Financial Services Accounting Advisory at BDO spans all aspects of accounting and financial reporting across 5 pillars: accounting change, structuring advice, financial instruments accounting and reporting, climate and corporate reporting, and all other areas of accounting. One thing that the Financial Services Accounting Advisory team at BDO has been doing since the onset of COVID-19 is engaging with financial reporting and prudential regulators in the UK and the EU, trade bodies, our peers both locally and internationally, and other parts of the wider community on the application of IFRS 9 under COVID-19. In terms of agenda for today, for the time that we have, we'll be spending some time on the context of COVID-19 in terms of accounting and financial reporting. We will then focus on some general considerations on applying IFRS 9 under COVID-19. We will also look at the PRA's BCO letter of the 26th of March. The EBA, ECB, and ESMA have made pronouncements that are similar to those of the PRA. In terms of context, COVID-19 has unfortunately had an adverse impact on a large number of the world's economies. This will impact financial institutions differently in different jurisdictions, depending on, for example, the location of their borrowers and the sectors they operate and work in, with such an impact being reflected in the financial statements. This requires the distinguishing between what is reflected in the financial statements in terms of recognition and measurement, and what is considered to be a post-balance sheet event. The consensus is that this is typically a post-balance sheet event for 31st December 2019 year-end, given the World Health Organization announced that COVID-19 was a global health emergency on the 30th of January 2020. This means in practice that detailed disclosures is warranted in the financial statements, and this is considered as part of going concern assessments in those 31st December 2019 financial statements, but does not directly impact the numbers reported in the primary financial statements and disclosure notes. Consideration therefore needs to be given to the recognition and measurement of the impact of COVID-19 for periods ending on or after 31st January 2020. We will now turn our attention to IFRS 9, but before we do, I would like to point out that we're running another webinar next Wednesday on the implications of COVID-19 on other aspects of accounting and financial reporting, under both IFRS and UK GAAP, including incurred credit loss models. First of all, in terms of expected credit losses, all things being equal, there is an expectation that ECL will increase. This is due to either the risk of the borrower defaulting increasing, and/or the amount the lender would recover under any credit risk mitigation strategy decreasing. This is true for any credit risk mitigation strategy, with these being workout, repossession and selling the collateral, or selling the loan itself. IFRS 9's general approach to impairment, which applies to loans advanced, loan commitments, and financial guarantee contracts, require 12-month ECL to be estimated for those credit risk exposure that are in stage 1, with the 12-month probability of default that is applied to these being suspect to increased volatility given the increased uncertainty. COVID-19 may trigger a significant increase in credit risk that results in the credit risk exposure moving from stage 1 to stage 2, meaning that lifetime ECL will need to be estimated. ECL also applies to financial guarantee contracts, which are contracts under which the issuer makes specified payments to reimburse the holder for a loss, because a specified debtor fails to make payments when due to the holder. And COVID-19 may impact both third-party financial guarantee contracts, for example, letters of credit and bank guarantees, amongst other similar instruments, and related party financial guarantee contracts, for example, cross-guarantees between a parent and its subsidiaries, or cross-guarantees between subsidiaries. This is in light of the increased likelihood of the specified debtor failing to fulfill its repayment obligations. In terms of modifications to financial instruments, there are increased instances of borrowers requesting lenders to modify the terms of a loan's contract, which can take various forms. And these include reduced interest rates, payment holidays, and covenant waivers. IFRS 9 has specific requirements for modifications, whereby this may need to be assessed in both qualitative and quantitative terms as to whether the financial instrument is a new or a modified one. While it is envisaged that a fair number of contractual modifications will not be to the extent that the original financial instrument is derecognized and a new financial instrument is recognized, given the nature of the contractual modifications that are arising as a result of COVID-19. However, it is to be said, though, that losses are still expected to arise in lenders' financial statements when the contractual terms of financial assets are modified, as the modified carrying amount is likely to be lower than the original carrying amount due to the deferring of cash flows and/or reducing of interest rates. One point on hedge accounting: forecast transactions under a cash flow hedge may no longer be highly probable, which would give rise to increase in effectiveness, or they may not be probable, which would give rise to hedge discontinuance and recycling of the cash flow hedge reserve to profit or loss. Before we move on, it is worth remembering that IFRS 9, in terms of ECL and generally, is a principles-based standard that does not, for example, prescribe when a significant increase in credit risk arises, or, by way of another example, how forward-looking multiple macroeconomic scenarios are to be determined. This gives rise to the need to apply judgment. And the application of IFRS 9 itself and judgment in fact requires lenders to adjust their approach to estimating ECL and also assessing significant increase in credit risk as and when circumstances change. And at the moment, we are faced with changing circumstances. An example of this is because the relationship between macroeconomic variables to ECL parameters, which are your exposure at default, your probability of default, and your loss given default, as well as your probability weights, may no longer hold true or provide intuitive results. Another thing worth bearing in mind is that 30 and 90 days past due, as indicators of significant increase in credit risk and default, are rebuttable presumptions, and it may now be more appropriate to rebut them if the evidence supports this. This is because the primary indicator of a significant increase in credit risk is a relative, unexpected increase in the probability of default over the credit risk exposure's expected life. There is information out there. For example, rating agencies are starting to publish this. An undue cost or effort does not mean no cost or effort. The information does need to be reliable and relevant. The whole picture needs to be taken into account when estimating expected credit losses under IFRS 9. And while borrowers are generally worse off with credit risk increasing, governments have introduced various fiscal measures to protect economies. This will inevitably give rise to macroeconomic scenarios, as well as the weightings assigned to them, changing and being calibrated over time as we move through the outbreak. For example, more severe downsides may be implemented and weightings skewed towards those downsides in total when compared to the base and upside scenarios. However, it is acknowledged that models cannot be recalibrated that quickly, so we're expecting to see a fair amount of this reflected by post-model adjustments and overlays. These will need to be updated as new information comes to light. And these post-model adjustments and overlays still need to be justified and substantiated in terms of how they have been applied and quantified. And remember, the ISB's raison d'etre behind IFRS 9 is to provide users with insights of where the entity is in terms of the credit cycle, and increased transparency is needed more so than ever in uncertain times. This will be achieved through adhering to the requirements of paragraphs 122 and 125 of IS1, Presentation of Financial Statements, which are qualitative and quantitative disclosures around critical accounting judgments and sources of estimation uncertainty, as well as IFRS 7 financial instruments disclosures that are associated with credit risk. Sam Woods, Deputy Governor and CEO of the PRA, wrote to CEOs on the 26th of March. This was in light of the significant measures taken by governments and central banks to encourage banks in their lending activities and their providing of support to economies. The PRA have stated that these measures are expected to remain in place throughout the period of COVID-19 disruption. This is particularly relevant for March year-end and quarterly and half-yearly financial reports onwards and going forwards until the foreseeable future, given the fiscal measures commenced before then. And ECL, like most accounting estimates, are estimated on the basis of both future cash flows and assumptions about the future. The PRA's letter and its annex focused on three key areas: IFRS 9 accounting and the definition of default, covenant breaches by borrowers and the treatment thereof, and the regulatory capital treatment of IFRS 9. It also considers forward-looking information when addressing these aspects and the impact of, for example, payment holidays, which we will talk through on the next few slides. The uncertainty associated with ECL estimates in a COVID-19 world will only be higher. Forward-looking information that reflects the macroeconomic impact of COVID-19 is limited, and thoughts on the overall impact is changing. For example, a few weeks back, there was talk of a sharp V in terms of how a recession would manifest itself. Now, talk is of more of a U or a skewed V with a longer period of recovery. This does present risk to estimating ECL, and sound and reliable assumptions need to be used so as to minimize the chance of materially overestimating or underestimating expected credit losses. The PRA has stated that two aspects are critical to this, and is of the view that the consideration of this means that it needs to be well balanced, and judgments need to reflect this. The PRA is of the view that these aspects adhere to the requirements of IFRS 9. Yes, the data is showing that economic and credit conditions are worsening, but public support needs to factor into the modelling. And economic theory taken into account, for example, mean reversion kicks in after 5 years. So, despite the outbreak, sound economic theory still needs to be factored into ECL modelling, including mean reversion. Second to judgment needing to be well balanced is the need to consider actions to support borrowers, and these may not necessarily automatically give rise to a stage transfer under IFRS 9 or a default under CRR. When it comes to data, economic consensus does lag behind public sector intervention. I would therefore advise to use information that is available on or around the 31st of March, but not the end of April or middle of May, as the latter may include factors that arose after the 31st of March. As I said earlier, there is an acceptance that the ECL impact of COVID-19 in terms of both significant increases in credit risk and ECL estimation itself will be achieved through an overlay. This is because the traditional drivers of credit risk may no longer work as they did. For example, government-enforced forbearance is to be considered in terms of was the borrower or group of borrowers on the edge of stage 1 and stage 2 before COVID-19 or not, with an overlay needed if they were not. I say this as freezing probabilities of default or stages pre the crisis is most certainly not compliant with IFRS 9's requirements, and it is probably easier not to suppress current triggers as their operating has been embedded now. This is why there is therefore a need to manually pull back these credit risk exposures to stage 1 or 2, and this may be operationally simpler to implement than the other way around. Some other considerations are because IFRS 9 requires assessing significant increase in credit risk over the lifetime of the credit risk exposure, then shorter-term exposures are intuitively going to be probably more impacted than longer-term ones given the duration of the recession. This will also manifest in forecasts becoming shorter-term, with the long-term trend possibly kicking in earlier when preparing these forecasts for the use of ECL modelling under IFRS 9. And it goes without saying not to double up or double count on other post-model adjustments or overlays for other political and economic uncertainty that you have in place at the moment, for example, in relation to Brexit. Days past due is losing its relevance, and while one needs to be more granular, a bottom-up approach may not be feasible. Therefore, there is a need to identify locations and sectors and consider these on a top-down portfolio basis, as certain significant balances or group of balances may be impacted more than others. I would advise you not to suppress probabilities of default or days past due for the reasons that we have outlined. We would also advise you to see relative movements in probabilities of default, with larger jumps being investigated more granularly. We say this as these are more likely to be indicative of credit deterioration as opposed to a lack of short-term liquidity. A point worth bearing in mind is that gaps do exist in terms of government assistance, and one should consider IFRS 9 as part of borrower eligibility testing so as that it can be modelled in later. The PRA specifically spoke about covenants, given the role these play in loan agreements. Similar to forbearance, lenders need to determine whether these are normal or COVID-19 induced covenant breaches. Examples of COVID-19 induced breaches are on the screen, and these include delays associated with the provision of financial statements, both audited or unaudited, compliance certificates that are needed in order to adhere to the covenants, and valuations that need to be prepared by third parties. Other forms of covenants are temporary changes in borrowers' reported earnings, suspension of business or other material adverse event clauses, and modifications of the audit report attached to audited financial statements. And in some instances, these 6 examples that we have highlighted on the slide will be example of COVID-19 breaches that arise as a result of the outbreak. As a result, the PRA understandably asked lenders to consider covenant breaches carefully during the outbreak. This is similar to the underlying theme of needing to determine whether the breach or waiver is due to credit deterioration or a lack of short-term liquidity. The PRA is clear in that COVID-19 induced covenant breaches should be waived. The PRA is also clear in that when doing so, lenders should not introduce new charges or restrictions on borrowers that are unrelated to the facts and circumstances that led to that breach. Also, modifications to audit reports will become the new normal for a while, and people will get used to them. These modifications could take the form of modified opinions, emphasis of matter, or material uncertainties. These again should not automatically give rise to a CRR default or a stage transfer under IFRS 9. On CRR, it is worth remembering that a covenant breach is a possible indicator of unlikeliness to pay, but it does not automatically trigger default per se. The thought process that I've just outlined extends to other COVID-19 induced breaches and waivers of covenants, in addition to those of modified audit reports. A few quick words on the regulatory capital treatment of IFRS 9. Transitional arrangements are in place whereby the regulatory capital of ECL is being phased in over time, and firms can add back 70% of IFRS 9 ECL in 2020. This is only the case if the firm opted into these transitional arrangements in 2017, which the PRA encouraged at the time, and these cannot be opted back into now. If a firm avails of the transitional arrangements, then all aspects of supervision of firms is performed under the transitional basis, and not the fully loaded figures, which would be without the 70% in 2020. This includes the determining of capital resource requirements. Thank you, Krista, for your question. To answer that, in terms of COVID-19, it is accepted to be a non-adjusting post-balance sheet event for 31st December 2019 financial statements. However, when we start to move the clock forward, i.e. if you're a 31st March 2020 year end, or you're preparing interim or quarterly financial information, then we would generally expect to see an increase in ECL for stage 1. So yes, your question is right, that is on a go-forward basis. And this slide summarizes some of the key considerations that we have talked through. Clearly, thought is to be given to the incorporation of forward-looking information, macroeconomic variables, multiple scenarios, and probability weightings. Definitions of what constitutes significant increase in credit risk and default need some considerations, with definitions being amended partially as a result of the outbreak. The combination of the first 2 points will give rise to the increased use of post-model adjustments and overlays, which still need to be substantiated and justified. These are not free passes. In practice, repossessions, for example, will be suspended, given the property market has come to a bit of a standstill. The likelihood of guarantees being called is heightened, with the expected credit losses thereon coming more into play. And lenders and borrowers will modify the terms of their loans, which will have measurement implications generally, but ECL implications as well. Governance processes are fundamental to all of this in terms of underpinning how well IFRS 9 is applied during the outbreak. This slide also summarizes some of the key considerations, with governance starting this list. IFRS 9 needs to reflect what you do in practice and changed accordingly when you change how credit risk is managed within your institution. High impact, low probability scenarios are to be captured, as is the case with any source of uncertainty under IFRS 9. The conditions of schemes need to be understood and reflected in IFRS 9 as quickly as possible as part of changed credit risk management practices. And borrowers need to be treated fairly. A final thought on this slide is the need for transparency and disclosures to the market, particularly when it comes to the application of critical accounting judgment, of which this is going to be increased for a number of reasons, as I hope you've come to appreciate during the course of this presentation, and the increased source of estimation uncertainty, which has also hopefully come to light as we have worked through this. And this is in both quantitative terms, in terms of sensitivity analysis and the impact thereof on stage allocation under the general approach and the ECL that has been estimated. And that is also in relation to the variables themselves and the parameters, and also qualitative terms, in terms of, for example, considering how overlays have been determined and how credits have been assessed, whether or not they're in stage 1, 2, or 3, because of forbearance and the extent to whether that is government induced or not. There are resources on both IFRS 9 and COVID-19 on our UK and global website. There are also Dan and my contact details on the screen should you wish to discuss anything that we've covered today or any accounting and financial reporting matter further. We would very much be happy to help you during these times. And on that note, I thank you very much for your kind attention to the slide itself. I hope that you found this useful and continue to keep safe and stay well. We will now take a few of your questions.
Mark, one of the first questions we have is, if COVID-19 is accepted as being a non-adjusting PSBE, why would you expect to see an increase in ECL for stage 1, or is this going forward?
It's the latter, it's going forward. So it depends where we are in terms of points in time. So if we're at 31st December 2019, then given matters really crystallised after year end, and they were not indicative of matters that existed at 31st December, then that is why it's a post-balance sheet event for 31st December year end. It will need disclosure as required by IS 10, which is the standard that governs events after the reporting date. It would also, I would expect COVID-19 to feature as a principal risk and uncertainty that is facing the business, and also would be featuring in the going concern assessment. And the reason for that is the going concern assessment is prepared on a 12-month from the date of signing of the accounts basis. And if we're signing the accounts today, then COVID-19 will need to feature in any going concern assessment between now and the 16th of April 2021. If, however, we roll the clock forward and we're now, let's say we're at 29th of February year end, then COVID-19 was more pronounced. So you need to factor that in more so to your ECL modelling under IFRS 9. And as we continue to roll the clock forward, 31st March, 30th April, 31st of May, the impact of COVID-19 will become more and more pronounced. So you will need to factor it into both your ECL modelling, which includes your assessment of significant increase in credit risk and default. It also would feature in your interim financial reporting if you prepare those and issue them under IS 34, and also any other financial statements that you issue after that.
Okay, great. We have another one here. We have a 31st 12 year end and signed our accounts mid-January 2020. Can we assume there is not action required with regard to 2019?
Well, I mean, the requirements change once you've signed your accounts. So the question then comes, it's not a case of whether it's a post-balance sheet event or not. I mean, the question then is, you're now in IS 8 territory. Did you get things wrong in terms of those 31st December 2019 financial statements? And I mean, there's a few things that can happen there. You could either have an adjustment arising, which is not considered to be material within the context of IS 8. And also, so that means that you would just reflect it in the 2020 financial statements. It may be considered to be a material error, which would give rise to a prior period adjustment. And if it's considered to be so fundamental and pervasive, then you may need to refile your accounts. I mean, but these are passive actions that occur after year end. I would personally be surprised if we're in the territory of either a prior period error or needing to refile accounts because of the fact that the outbreak was not as manifested as at 31st December as it started to unravel in January. And it is accepted that this is very much of a January 2020 event than a 2019 event. Now, clearly, there may be some lenders who operate to entities that were more adversely impacted in December, for example, those close to China possibly, so they would need to have a longer pause for thought. But what I outlined, I would expect to generally apply.
Okay, great. Where interest holidays are granted, what is market practice in terms of interest on interest, i.e., is interest deferred capitalised on the due date or not?
It depends, is the short answer. I mean, if you're granting an interest holiday, I wouldn't expect you to be charging interest on that interest holiday. against the backdrop of treating customers fairly, because that's basically telling them they're going to pay you more interest on the interest that they haven't paid you. So I would expect it to be more of a revision to the cash flows than the actual interest rate itself, which means that you're going to have a debit or credit, a gain or loss in your P&L, which some of you may recall under IFRS 39 as an AG8 adjustment. It very much depends on the terms in terms of how they're modified. My initial reaction that interest on interest is punitive, and it could attract some unwanted attention of doing it at this point in time. But I would expect it to come through a revision to the estimates of cash flows. So that means you'd keep the interest rate as it was, and then you would have an adjustment to profit or loss interest income. Having said that, if you are substantially modifying the terms of the loan, then you need to assess whether you have derecognition. And that means you need to compare the carrying amount that you have on the balance sheet under the original terms, and you'd also need to consider what the carrying amount will be for under the new terms. And if there is a material difference in both quantitative and qualitative terms, then you need to derecognize the existing financial assets, re-recognize the new financial assets, and the gain or loss will be again recognized in P&L. That new effective interest rate in that scenario would be under the new financial asset terms, not the original financial asset terms. And the reason why I say I'd expect it to be a revision to the cash flows is because I wouldn't expect you to be, if it's a variable rate, then you wouldn't be seeing interest on interest. And if it's a fixed rate, then you typically revise the cash flows in such instances.
Okay, thanks, Mark. We have another one. I hear a lot of talk of modified audit reports for 31st December 2019 in light of going concern. But you said it is a post-balance sheet event for such year end. Why are audit reports being modified then?
This is because the going concern of the entity is assessed for at least 12 months from the date of signing of the accounts. So if a set of financial statements is signed, say, on the 31st of May, then that going concern assessment will go to 31st of May 2021 as a minimum. And COVID-19 is going to have to feature in that assessment. Now, under auditing standards, given the uncertainty associated with going concern in light of COVID-19, this would typically give rise to material uncertainty being disclosed in the audit reports. And what that would do is it would say, look, as disclosed in XYZ note, then there is a material uncertainty on the going concern, but that is still a modification to the audit report. The PRA has said that modifications to audit reports are expected, more so than ever. The FRC has said as much as well, and that is the National Competence Authority for Financial Reporting in the UK, as well has the FCA, which is the listing authority in the UK. And this is also why regulators are asking entities to delay the filing of their financial statements, so as that the going concern basis on which the accounts are fundamentally prepared can be considered properly. And this allows management time and their auditors time to do the work necessary on this critical accounting judgment and estimate.
Great, thank you. And I think we have time for a final question or two. So you've mentioned cash flow hedge accounting, but is there no impact on fair value hedge accounting?
If we think about it, cash flow hedge accounting in some instances results in deferring the gain or loss on the derivative and other comprehensive income, but fair value hedge accounting gives rise to a broadly equal and opposite adjustment to the carrying amount of the hedged item. So, if the fair value of the derivative decreases one way, then you would expect a broadly equal and opposite increase of the fair value of the hedged risk the other way. So that's going to be a natural offset that will be recognized in P&L. So that's why we mentioned cash flow hedge accounting and the possible considerations needed in that space. However, we expect less of an impact at this point in time in relation to fair value hedge accounting for the reasons that I've outlined.
Thank you everyone for your time this morning. Apologies for the audio issues. As Mark mentioned, we will send follow-up email later on this evening. which will have all the slides and the recording of the webinar. It also includes Dan's and Mark's contact details, so please feel free to reach out to them if you have any further questions. Thank you for your time this morning. Bye.